Affordable Care Act Tax Penalty Explained. Under the Affordable Care Act, if you can get health insurance and choose not to, and you aren't exempt for any other reasons, you may have to pay a tax penalty. The tax penalty is calculated based on a percentage of your household income, or a per person or per family rate, whichever is higher. For the 2014 tax year, the tax penalty amount is either 1% of your household income or $95 per uninsured adult and $47.50 per uninsured child, up to $285 per family. In 2015, the amount increases to 2% of your household income or $325 per uninsured adult and $162.50 per uninsured child. In 2016, this amount increases again and adjusts for inflation every year after that. The penalty amount is also based on the number of months you or your dependents were uninsured. If you're uninsured for less than 3 consecutive months, you won't have to pay a penalty for that time period. This is called a short gap. If you have more than one short gap in coverage during the year, your penalty exemption only applies to the first gap. When you file your tax return for the year you were uninsured, your tax penalty will either be deducted from your refund or added to your tax bill. By law, the IRS may not use liens or levies to collect Affordable Care Act tax penalties, but they may take the penalty out of your expected tax refund. Still have questions about the Affordable Care Act tax penalty? Visit TurboTax.com to learn more about the Affordable Care Act and how it may affect your taxes.